Now we're going to turn to Asia and look at some of the Asian output index. And we want to look at some of the bigger pieces of Asia Pacific, what's happening there, and then look at what's happening with China and some of the slowdowns that we've talked about over the last few months, or I should say last 12 months, and how we're starting to see, again, as we've talked about at the end of August, we're starting to see some benefits and some shifts that are starting to come through and come to light, but we'll talk about them again in a minute. But when we look at Asia Output Index, so when we look at the consumer services and then we look at, that is where we keep seeing these slowdowns. Now, forestry and paper products, pharmaceuticals and biotech are up, and not surprising why they're expanding when you look at PPE and all other types of means of medicines, shortages, and a lot of the like. So that is going to continue to be fairly stable, but the consumer services and the forestry paper side, but the consumer services is the one that when you look at what is the slowdown and how it's continued to develop in the developed world, really, where you keep getting these slowdowns, that is going to, again, impact Asia on a greater amount when you consider how developed goes to emerging markets and that kind of flows down. That's going to be some of those pressure points that, again, is going to, again, weigh on where that growth is, because we already know manufacturing is slowing. That is already apparent. But now you get the service side that never really recovered to the same degree that manufacturing did. And that's where we're going to continue to see some of these pressure points. Now talking about global manufacturing PMI and credit impulses, this is just showing how things have weakened and how we continue to see these pressure points that as the credit impulses weaken in general, and you see some of that coming through, leading the market by 12 some odd months, you can see just where that manufacturing is, because at some point you're again, the consumer is going to refill their inventories, or they're not willing to pay the price of these goods, and you'll see this pressure as demand dwindles. And some of these companies continue to try to essentially rebuild that inventory that they've lost. But based on pricing, they're not going to try to rebuild all of their inventory at this pricing, but just getting to a more manageable level as they try to, again, try to work with the current price dynamics and these paradigm shifts that we continue to see in the supply chain. So now when we turn to Japan, we want to touch on some of these key pieces, and then we'll break them out in a bit more to a greater extent. So when we look at August, again, August started, July got better, August got a bit worse. So when we look at some of the shifts that we're seeing overall, it's not that August got much worse. It was just a little bit less than July, a little bit of pressure, but still getting there in terms of where things were. July, because when you look at what happened in July on household spending, expectations were for 2.4%, came in at 0.7%. August is going to be better than 0.7%. That is not even a question. It's just, it won't be as good as, the previous month, the previous expectations, and essentially what was expected to come into July was essentially spread between July and August, with some of that pressure that has persisted into September. Still going to be better than August, but because we are on that upswing. So July was again missed estimates. August will be a bit better. September should be a bit better than that. And it's when we start looking at trade balances overall. But really, we want to shift down to the bankruptcies and the Econ Watchers survey. So when we look at the survey in general, we can see the pressure that has come through when we look at survey economic watchers. And when you look at the survey of 45 and the actual coming at 34.7 for August, then you look at the survey outlook, was expected at 46.2, came at 43.7. So you're seeing that slowdown that we talked about in August. So it's still going to be better on a household spending level versus July, but expectations were even higher for August, and that's where we keep talking about, again, these expectations coming down. GDP for 2Q, when you look at it in general, it's fairly in line, some adjustments in general, but we want to look about what is coming in Q3, what is coming into Q4. So now when we shift to Japan's service PMI business activity, Household service expenditures have continued to come down a bit. When you look at just services overall, deeply into contractionary territory at 42.9 in August versus in July at 47.4. Again, like some things have come down. We expect some things to get a little bit better, but in general, August was weaker than July, and July was, some things are going to mix in general, and that's, I think, an underlying issue of some green shoots are there, but then there's some offsetting capacity. And when you just look at spending in general in Japan, on a historical level, on a cultural level, savings always remain fairly low. And that again carries out through the situation, which keeps these pressure points, keeps the levels of activity muted. Again, it'll be better as we come into September. It'll be better than 42.9, but not expansionary. And again, that's where we continue to see those pressure points. So then, when we look at retail mobility shifting to South Korea, which has done better than Japan, but still has some of the overhang that we've talked about when we look at retail recreation mobility, still seeing some expansion. But when you look at it in some of the city centers, like in Seoul, you can see it's come down, and daily COVID cases have started to still remain elevated, but people have almost learned to deal with it. And that's the interesting side, because even though we have this big expansion of cases, you're not seeing the same drop down in activity because you're on the other side of it, which is what we've been talking about, where a lot of the data is already dealing with high COVID cases and people that are like, look, we have to get back to life. We're getting some vaccinations. We're feeling better about things. And that's, I think, the disconnect, where the issues that remain are more deep-seated. There's more economic issues in that, in terms of what is the consumer going to do? What is GDP growth going to look like? When you look at South Korea, again, they raised rates. And why did they raise rates? Well, let's look at inflation by the breakdowns in general. So here you can see what the target is at 2%, and where they're currently running at almost 2.75%. And what is driving that? And that is the biggest issue in general. You have food, which has been driving it, housing and water, restaurants. But when you look at transportation, the transportation side, again, remains elevated. And based on what we're seeing with imports, what we're seeing with exports, it's still going to remain a big pressure point. As we talked about last week, when you looked at South Korean exports, imports, they've been fairly stable. They've been fairly strong. A lot of that has gone into China as they try to kind of bridge some of this gap, try to create some of that inventory that we've been talking about. But the central bank decided to try to get in front of some of these inflationary pressures, again, increasing it by 25 basis points, not a huge increase, but still seeing a little bit of a bump to try to protect against some of these inflationary pressures that remain and continue to push through the Asia Pacific region. Where India PMI services for August, came in at 56.7 versus the prior 45.4, and the PMI composite came in at 55.4 versus the 49.2. Now, things are fully open. This is capturing that reopening surge, and now a little bit back to normal. But even on a reopening pop, you can kind of see, again, it's still good, it's still expansionary, but you're not getting the same type of increases that we've gotten because things didn't slow down as much. So that's where you get the muted to the downside, muted to the upside. But when you look at diesel capacity, you look at economic capacity, inflation remains a big issue in India, and that's going to be something to watch as prices for imports, exports remain elevated. Now, when we turn to Taiwan for a second, one of the ones that I wanted to look at, obviously CPI continues to go higher. CPI core expected 1.2, came in at 1.33. CPI year over year was expected at 1.9, came in at 2.36. But when we look at exports, imports, so exports were expected to be at 23.4, came in at 26.9. Imports were expected at 30.2, came in at 46.3%. So remember, imports directly correlate to exports, especially, I shouldn't say all the time. In an exporting nation like Taiwan, you import the raw material, semi-finished goods, and you export either the finished good or semi-finished good. So the exports, when you look at an import surge like that, that's supportive of just a continuously strong export movement. The question will become, how much disruption does this typhoon bring? How much are things shut down? Flooding, damage. What does that do to the supply chain? Are things going to take a week to fix, a month to fix, 3 months to fix? These are going to be some of those shifts that we're going to have to look at. So even though we should see a big increase in exports, some of that could get pushed into November, October, and into November, depending on the timing, but still a fairly strong backdrop. So then when we look at India service PMI, this is what we just want to look at it now in terms of some of these backdrops, because India is an important side. In segment 1, we talked about the increasing exports into Europe and trying to do that through the Middle East and how that would be structured. But now when we look at the service PMI, here's where we're back to those levels that we've seen. But it's what is going to happen to the GDP side, because GDP, as we've been saying, they were very elevated estimates, and we just don't see it getting back to that growth. And again, we think estimates are going to continue to come down, using export markets, using diesel as a bellwether for economic strength. They're just not there, and they haven't really been able to capture some of that growth, which again is going to lead to some of that inherent slowdown. Now we want to talk about China, and before we get into some of the data sets, we want to talk about Evergrande bonds. So when we look at what happened with today, so when we look at the shifts in general, this is coming from REDD, R-E-D-D. They've come out and said that a warning that default appears probable. The dollar bonds of China Evergrande fell to fresh lows after a report from financial intelligence firm REDD, that the firm plans to suspend interest payments on loans from 2 banks due September 21 and asked a lender to wait for instructions about an extension plan. So we're coming into a technical default or a selective default in terms of how the rating agencies would look at it. It occurs when a borrower fails to pay one or more of their obligations but continues to meet other payment obligations, and usually precedes a full-blown default and or bankruptcy, although in China the distinction tends to be a bit convoluted. So here's where that came out. That brought all the bonds down. And now you're looking at more pressure in the emerging market world, because when you look at the indexes, a lot of that is weighted to China. And now, as people like to call it, China's Lehman event, when you look at Evergrande, this is becoming a much bigger problem. They've also called in several more tech companies, which just means that there is a potential for additional pressure on what are they going to have to pay. Are there going to be breakups, increase in fees, taxes? Again, all of this is leading to more crackdowns, more pressure on just what growth can look like as we head into the end of the year. So now looking at Chinese data. So when you look at as we talked about last week, the PMI composite came in at 47.2. CAC and PMI services expected 52, came in at 46.7. So you're seeing that slowdown. And when you look at in general, estimates were for 51.3 in CAC and services. So you're talking about some real slowdowns. But this is August. So now when we look into September gets better, because the end of August got better as we headed into September. So you'll see some of that kind of perk back up. And now looking at what happened in August exports, well, exports were expected to be at 8.4%, came in at 15.7%, and imports were expected at 18.5%, came in at 23.1%. Remember, there is that huge backlog. So you did have this unleashing that needed to be done, essentially this fear or this movement to try to move product through the system, catch up with these backlogs. But when you look forward, remember, new export orders dropped. Backlog is starting to come down, but the new export orders, so that's in the future. So that's when you look at where things are. This is a big catch-up number, but imports were still elevated, so you will get some export support. And you did have huge COVID issues in other nations. So as we were saying before, people kind of shifted from China into other nations. Then those nations had COVID, so people shifted a little bit and pulled a bit more from China. So you're going to see some of this balancing act in general. Now looking a little bit further, again, as we talked about with Evergrande, and now what's going to happen with tech. So that was the party's message to private firms on Wednesday, published a front page editorial reassuring them that officials will still have their back, because there's a concern on what is this common prosperity going to mean for smaller firms, because they don't have the balance sheet. They don't have the capacity to pay what Tennyson, Alibaba have to kind of create this support, which is where we see right now. The ongoing tech crackdown and new push for common prosperity have seriously scared China's private companies. More context in general, this marks the second time this week that the party showed some love to the private economy. But let's talk about the editorial in the People's Daily. So Liu's message was, the regulations and policies introduced treat everyone equally. They're aimed at violations of laws and regulations that by no means single out specific industries or companies. The commitment to create a good environment and provide more opportunities for the development of the non-public sector of the economy have not changed. It's just the target of it has changed. They're trying to support micro, small, medium businesses, and that's where you continue. They called in more tech companies, so we'll hear more about that over the coming few weeks, and we expect more crackdowns, which again is going to lead to what is their economy going to look like on a growth side. So now, putting all of that into perspective, we have to look at and have to consider, well, what about liquidity? Where is this liquidity going to come down to? And at Tuesday's State Council press conference, the PBOC Vice Governor Sun Juanfeng looked to reassure markets about the liquidity crunch. So when you look at what is coming, because remember when we talked about that RRR cut, there were expirations coming up that would be able to offset some of that injection. And there's a lot of liquidity that can get drained from the system. So end Q3, typically as Q3 comes to an end, banks still will need to stash some cash and clean up their books to meet, again, the requirements. This is quotes coming from Trivium. Renminbi 2.5 trillion worth of medium-term lending facilities are set to expire in Q4. Because remember, those medium-term, those MLF, the medium-term lending facilities was what we were talking about, of ways that they can manage some of this liquidity, push it through the RRR, let some of the MLFs expire, not all of them. And now when you look at ways that are going to get readjusted again, we expect a RRR cut at only the small and maybe medium banks, with some of that being offset with the MLF exposures. In late August, the Ministry of Finance signaled an increase in approvals for local government special purpose bonds, which will also suck down bank finances, which, again, coming back to the RRR cut, as those SPBs get kicked out, they'll have to try to reestablish, which is just going to be another means of just putting money into different places, but not increasing the total amount of liquidity. And then if the U.S. Fed continues to cut, or decides to ease some of their reduce their blind printing, what is that going to do to China? And they'll have to try to mitigate and manage those systems. So again, those are things that are going to happen on the cash flowing side. But when you look at the liquidity gap, the People's Bank of China has sufficient tools to smooth the periodic disturbance of liquidity and can maintain reasonable and sufficient levels. As they've been highlighting for months, the PBOC is no longer focused on the size and scale of liquidity operations. Instead, it increasingly looks at the key money market rate, the DR007, to gauge liquidity dynamics. Based on this money market rate, the money markets are operating smoothly, and there's no large fluctuations. So again, they're seeing some balances. But as we get into Q4, and given what's happened with Evergrande, what's happened with other potential defaults or rolling defaults, how is the PBOC going to respond to that, especially when we consider about these downturns in some of the PMI levels, when you look at manufacturing coming down, but the new factory orders is the one that we're talking about, and the new export orders. So new orders, so what's to come, are going down. which again is going to keep that pressure going. Even though we saw some strength coming into September, there's still some of that caution as we go forward, where they'll get better, but not this great expansion that we've seen and heard in other places. And then the China's corporate market, to give you an idea of the size, is huge, but it's dominated by the state-owned enterprises. But if China's willing to get a bit stricter on, well, what are we really going to backstop? What are we going to let fail? Even though they're SOEs or state-owned enterprises, you don't have the same type of comfort that we've had in previous cycles, which again is putting pressure on that bond market. And then when you look at real household spending, so when you look at real household expenditures rose 0.7% from a year earlier after a revised 4.3% drop in June. That was far below the consensus forecast of 2.4% increase, but well above some expectations. Month-over-month term spending dropped 0.9%. Real disposable income fell 3.7% year-on-year after a 13.6% drop in June. So this is what they're trying to address. When we talk about PPI versus CPI, consumer spending is languishing, and increasing CPI isn't going to help, but wages are a big problem, which is why they're trying to drive up or increase the compensation to workers to support or enable the dual circulation strategy to work. And common prosperity is a way to do that, of taking money from one side and pushing it down to that lower end to try to, again, drum up some of that excess capacity. So then when you look at the credit impulse, they continue to remain tight. So tightening is slowing that economic momentum. So when you look at credit impulses across the G3, it's not just China. So the commodity index, even though technically it should continue to fall based on where we're getting that liquidity side, there's still that supply disruption. And the supply disruption is what's providing some of this bid that is going to continue to keep some of this inflationary pressure, even though it should start to come down because demand should start dropping. But we're seeing some of that drop in demand, but the supply disruptions are offsetting that drop, again, keeping some of that elevated in general. So then when we start looking at how does this fit into China? So when you look at the headlines in general, the trade surplus for China was 58.34 billion in August compared with the surplus of 56.58 billion in July. And the consensus forecast was for 17.3% year-over-year expansion. So you still saw some of that movement. So most people expected July's exports to be weaker, especially as China's second largest port was shut for 2 weeks last month due to a COVID-19 outbreak. So again, you should see some of that, but there was that big catch-up that kind of offset. And then what are some of the explanations? So this is what Trivium was coming out with. Companies overseas brought forward Christmas orders for fear they would miss out due to supply bottlenecks. COVID-19 outbreaks elsewhere in Asia diverted some export orders to China, something similar to what we were talking about earlier. But we've been talking again about those Christmas orders for weeks now, and now you're starting to see that come into more of the mainstream. Most analysts, Trivium included, expected weaker exports to slow economic growth over the rest of the year. If China's export boom continues, this will provide some support. But as we talked about those new export orders, those new factory orders, a lot of as we were talking about, the Christmas side was pulled forward. So you don't need to see that come through. So that's where you saw that peak, and now it's going to be a matter of trying to fill some of these backlogs and these bottlenecks. So we still see that slowdown continuing, or I should say the headwind to growth continuing. Like, this isn't this marked shift of, oh, now they're going to see a huge increase in trade. It's just things got bad, they strengthened a bit, and now we're going to see some of that strength carry through the next 2 months, but not surge to offset that slowdown that we're seeing internally within China. And respondents to the MBS manufacturing PMI reported that new export orders fell for the fourth consecutive month in August. This data series has been fairly reliable leading indicator for export shipments. Again, that MBS manufacturing side that we're talking about. The sharp drop in the headline manufacturing PMI index last month also signals a struggling sector. Today's strong export numbers aren't enough to alter expectations for the Q4 slowdown. And that's, again, I'm in the same camp. That's been my camp for a while now. and I don't see that adjusting. So this is just giving some indication on where that growth is shifting. When you look at import trade, the imports still remain high. Again, imports elevated, support some of those exports through the next few months. I'm sorry, the next month or two, but the lack of new orders, you're just filling backlog, and that dissipates fairly quickly. But when you look at the foreign exchange reserve, so still things are elevated. They have about 3.2 trillion sitting on the balance sheet. But when you look at Evergrande, you look at SOE exposure, you look at bond defaults, rolling defaults, how concerned are we? How much of this is going to be able to provide some of that collateral that is missing, and to try to support some of these rates as we go through, and not only the federal government, but also the CCP, but the provinces and these special purpose bonds, they have to try to protect some of these interest rates because they can't let rates get too high. So this is why it's so important to have these reserves on the sheets. So now let's talk about common prosperity for a minute. So Alibaba has common prosperity focus. Yesterday they tried to outdo Tencent with Alibaba announcing it will launch the top 10 Alibaba actions for common prosperity, including investing 100 billion renminbi into good things by 2025. Again, trying to fit the narrative and avoid the ire of the government. And then when you look at what happened, an article in state media today took aim at practices on Chinese home rental platforms, again, going after the consumer cost, going after, well, what about housing? And remember, they're going after housing, private education. This is something that is going to be, we're going to have to watch it. And again, leading back to Evergrande with a huge real estate footprint, this is not something to be ignored. In Beijing, home sharing platforms are coming under scrutiny. Again, Caxton reported that a majority of non-hotel listings have been removed from Airbnb-style short-term rental platforms on the orders of the city government. So let's talk about microchips for a second. So, or semiconductors, especially when we factor in what's happening in Taiwan, what's happening abroad. Semiconductor Manufacturing International Corp announced that it will invest nearly $9 billion US dollars to expand production capacity. Long term, this is good news for China's tech, given current short-term issues. The problem is it will be a few years for the plant to come online. Also, the new factory will be producing chips at 28 nanometers and above, which isn't really the cutting edge that has been, the bigger focus. So when we look at coming forward today, the MIIT announced that automakers would be subject to less regulatory paperwork for auto chip security inspections, again, trying to bridge the vast supply chain issues that we continue to see. Now, when we look at some of the different episodes as we've had the outbreak in China, this puts it into perspective, looking at retail sales month over month and industrial production, where things were slowing between outbreaks on both the retail side and when you look at the retail and industrial production. So we can say that the lockdowns caused problems, but things never really got back above growth, even when they faded in April. And this leads to what we've been talking to, this, we can't keep blaming COVID. COVID is not the underlying problem, or it's not just it's not the only underlying problem. There is an economic slowdown out there that still continues to rear its ugly head, even though there's so much liquidity, there's so much stimulus. The RRP in the US just came across again at over $1.1 trillion. So there's nothing, we're not short liquidity. It's just we're short economic growth, where the consumer is saturated. There's not much more that is going to happen, again, leading to, I think, in the eventual realization that we're going to have some sort of slowdown. But is it going to be a hard landing or a soft landing? And given how elevated we are, where we're sitting right now, it could be much harder than I think people want or hope for. So that's all we have for you today. Hopefully that was helpful. It was a little bit shorter. Again, we got to leave out a section. So if you have any questions, you can find me on Twitter. We love the emails, or just in the comment section. We do appreciate it. So again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.